Price to book value is the default playbook metric retail investors trust to spot value in a stock. But for banking stocks, a standard price to book ratio looks exactly the same, whether a bank's balance sheet is an indestructible fortress or a complete house of cards. Relying on it blindly is an invitation to capital destruction. If you are holding a bank stock for retirement income, that gap should worry you more than any headline number. I want to show you exactly why the standard playbook breaks down the moment you apply it to a bank and what to check instead. This is not about picking a winner. It is about making sure you are not the one who gets caught when the book value everyone trusted finally catches up to reality. Most retail investors look at an SGX bank stock and immediately reach for price to book or price to earnings ratios because that is what standard corporate analysis teaches us. But if you are building an income portfolio for retirement drawdown, relying on these generic metrics is a structural trap. Banks do not own factories or physical inventory. Their financial statements are built entirely on shifting contracts. By the time a broken balance sheet finally shows up as a compressed book value on your screen, the damage is already absolute and your capital has evaporated. Your investment strategy depends entirely on your ultimate destination. If you are a momentum trader chasing short-term capital gains, standard corporate multiples might clear your hurdle just fine. But if you are an income retiree focused on wealth preservation and a dependable drawdown income, your safety demands a completely different lens. The standard industrial playbook breaks down completely when applied to financial institutions. To secure your cash, there are 4 specific capital safety metrics that actually matter for your portfolio. To understand why standard metrics fail, we have to look at how a bank functions. When you audit a property developer, you look at the gearing ratio to see how heavily leveraged the business is. But on a bank's financial statement, standard debt ratios literally do not apply. A bank's primary assets are the loans it hands out to borrowers, while its primary liabilities are your very own deposits sitting in your savings account. If you treat customer deposits as raw debt, every single bank on the SGX would look hopelessly insolvent overnight. The structural mismatches do not stop there. The standard interest coverage ratio is entirely meaningless here, because collecting interest from borrowers and paying interest to savers is the bank's core business model. On top of that, because banking assets are financial contracts, book value can shift overnight based on accounting provisions rather than physical cash flows. The fix is simple. You must throw out the standard industrial metrics entirely and evaluate regulatory capital cushions instead. To evaluate a bank safely, we track 4 specialized metrics instead of generic corporate filters. We look at the transitional CET1 ratio as an emergency capital cushion, the NPL ratio as our primary loan quality signal, the NIM to gauge core profit margins, and the payout ratio to ensure dividend sustainability. Each of these metrics answers a specific question about whether your income stream is actually safe. Moving past headline narratives to show the raw numbers, let's look at the first gate, which is the Common Equity Tier 1 ratio. This measures the proportion of a bank's risk-weighted assets funded by its highest quality capital, meaning money that isn't borrowed and isn't owed to depositors. It exists purely to absorb unexpected losses first before anyone else's cash is put at risk. The Monetary Authority of Singapore sets the regulatory minimum at 9%, but my forensic bar sits at 16%, 75% above that floor, ensuring a genuine safety margin. The second metric is net interest margin, which is what the bank earns on its loans minus what it pays out on deposits. In plain terms, this is the raw profit margin on the bank's core product, which is money itself. A bank borrows from you at a low rate and lends it out at a higher rate, and NIM tracks the health of that spread. When this core engine drops below 1.5%, it triggers a soft flag, signaling the bank is losing horsepower. When benchmark interest rates begin to fall or fierce deposit competition heats up across the market, the spread narrows immediately. The bank begins earning less profit on every single dollar it handles, even if its total lending volume holds completely steady. This is why our soft flag threshold is set at 1.5%, acting as an early warning system for income investors long before the pressure shows up in headline profit numbers. The third metric is the non-performing loan ratio, which tracks borrowers who are 90 days or more behind on their payments as a percentage of the total loan book. This tells you exactly how many loans are turning sour. A rising NPL signals that lending standards slipped during the good times and are now being tested. We flag anything above 2.0% as a concern and anything above 3.5% as a serious red flag, meaning dividend cuts are looming. The fourth metric is the payout ratio, which is the percentage of net profit paid out as dividends. For an income retiree, this is an essential gauge of operational discipline. When a bank sustains a payout ratio above 70%, it enters the danger zone. It is exactly like a household spending every single dollar it brings in with nothing left over for emergencies, which works perfectly fine until the storm hits and the buffers disappear. When you evaluate these four metrics together, they tell a complete story that no single number can show alone. Capital adequacy, core margins, asset quality, and distribution discipline must all align. A bank can easily look safe on any single metric and quietly deteriorate on another. To pass my forensic registry, a bank must clear all four structural gates simultaneously, not just the single metric that happens to make the best media headline. Under this framework, we filter banking entities through a specialized capital strength and yield metrics rather than industrial debt metrics. A bank cannot achieve a Zone 1 fortress status on capital strength alone if its dividend output fails to clear our income hurdle. Even if a bank carries a spectacular capital cushion, a compressed yield will automatically drop the stock into a lower zone for an income drawdown portfolio. Many retail investors assume a bank with a transitional CET1 ratio of 17% is an automatic buy because the balance sheet is indestructible. This is a confusion of targets. High capital ratios mean the regulators are happy and depositors are safe, not that the bank is an efficient income engine for you. When equity valuations rise to highs, that fortress capital gets spread across a more expensive share price. Capital safety and dividend utility are two separate gates. Let us run a fresh live case audit on Overseer Chinese Banking Corporation using these exact parameters. Looking at the data, the bank's transitional CET1 sits at a pristine 17.0%, passing our 16% bar. Its net interest margin is reported between 1.76 and 1.82% for the first quarter. Its NPL ratio is excellent at 0.9%, and its payout ratio is safe below 70%. However, its ordinary yield sits at just 3.06%. Failing our 4.7% hurdle. This audit showcases exactly why the framework is so unyielding. Every single capital and asset quality gate passes cleanly, some by a very wide margin. But under my forensic rules, a single hard gate failure overrides everything else. Because the ordinary yield fails to clear the hurdle, OCBC drops into Zone 4, caution, with the yield shortfall standing as the sole, absolute constraint against an otherwise pristine balance sheet. Let's look at why the drop to Zone 4 stands. The transitional CET1 of 17.0% clears the fortress threshold easily, and there are zero soft flags on credit or revenue stability. But the ordinary yield of 3.06% is a hard gate failure against our 4.7% hurdle. Even adding the special dividend brings total yield to just 3.64%. Capital strength and income adequacy are two separate questions. To maintain safety, we apply a conservative stress test buffer floor of 3.2% to our model. We audit for the storm, not just the sunny day. Even though the latest 6-month T-bill auction cleared at a low 1.50% per annum, we do not lower our standards to match a temporary low-rate environment. Our baseline floor remains at 3.2%, plus a mandatory 150 basis point risk premium, setting our minimum hurdle at 4.7%. Context is everything when analyzing these outcomes. A reader with a genuinely longer runway before drawdown may reasonably choose to tolerate this yield shortfall in exchange for OCBC's immense capital strength and its potential for long-term dividend growth. But remember, this framework is strictly calibrated for an investor drawing down soon, not for every investor at every stage. Capital held beyond core retirement needs can look at a different standard. Our 4.7% hurdle is benchmarked directly against the CPF special account rate, which represents the highest quality guaranteed SGD yield available in the system. This is not a literal redirect option for your funds, as retirement sum ceilings limit new contributions for many readers. Instead, it serves as an absolute measuring stick. A Zone 4 verdict is a timing verdict, not a permanent rejection. If the dividend grows or the price corrects, the zone changes. In this volatile market, the structural difference between a genuine sanctuary asset and a dangerous yield trap is decided in a single trading session. While free subscribers are left reading yesterday's news, Iggy's elite investors are actively cross-checking the next setup together in real time. Members of Iggy's elite investors gain immediate access to zero-day breakdowns, receiving the full forensic picture the moment it is finalized. They track the complete red zone watch list of flagged names and utilize institutional-grade cheat sheets built around our 5-layer audit process before the market opens. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you stop acting as the market's exit liquidity and start positioning your capital like an analyst. When you review your investment dashboard this week, skip the standard industrial filters and use 3 simple rules. First, check the asset quality baseline to ensure the NPL ratio has not ticked above 2.0%. Second, verify the regulatory access to see that transitional CET1 provides a clear margin above the MI's floor. Third, audit ordinary dividend quality by stripping out special one-off payouts to ensure the recurring yield outpaces risk-free options. Net interest margin compression is the silent assassin of banking profits. When benchmark rates stabilize or soften, the margins banks extract from loans narrow immediately. If a bank is already paying out a high proportion of its earnings to sustain its dividend, even a minor profit dip puts the payout under immediate threat. Margin pressure always moves faster than most retail investors expect. For a retiree in active SRS drawdown funding monthly living costs, OCBC's compressed yield fails to compensate you for equity market risk today. The business itself remains completely sound, and its capital position says so clearly. But the current price is simply too high to get you paid adequately for income. Watch it closely, but do not deploy fresh retirement drawdown capital here until the ordinary yield clears our 4.7% hurdle. A fortress balance sheet does not buy a bank an exemption from the yield hurdle. That is the entire discipline of this framework demonstrated in a single example. Gate 1 requires absolute capital strength, defined as a CET1 above 16%, an NPL below 2%, a NIM above 1.5%, and a payout under 70%. Gate 2 requires absolute yield adequacy, with ordinary yield clearing our 4.7% threshold. Both gates must clear. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description, 0-day access on Substack and YouTube, full Red Zone watchlist, and institutional grade cheat sheets for $9 a month. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.